Here's something that might sting a little. Most traders believe they're being smart, disciplined, and methodical in their approach. They think they're doing everything right. They analyze charts for hours, move their stop losses to give trades breathing room, keep detailed journals, and grind through losing streaks because they believe persistence equals success. But here's the brutal truth. You're probably sabotaging yourself. Those habits you think are making you a better trader, the ones that feel responsible and professional, many of them are actually psychological traps disguised as good practice. They're quietly destroying your consistency, amplifying your stress, and keeping you stuck in cycles that feel productive but lead nowhere. If you've ever found yourself saying things like, "I just need to analyze this setup one more time," or "I'll move my stop loss just a little bit," "This trade needs space to work," or "I need to trade more to build discipline," then this video is going to feel uncomfortably familiar. The most dangerous part? These habits feel right. They masquerade as wisdom. They make you feel like you're being diligent, patient, and professional. But underneath, they're feeding the very psychological demons that destroy trading accounts. Fear, greed, impatience, and a desperate need to control outcomes you simply cannot control. What I'm about to share with you isn't another list of basic trading rules you've heard 1,000 times. This is about the invisible psychology traps that even experienced traders fall into, habits that feel like solutions but are actually problems in disguise. These toxic habits are sneaky because they often start as genuine attempts to improve. You begin overanalyzing because you want to make better decisions. You move stop losses because you believe you're being flexible. You trade more frequently because you think it builds discipline. But somewhere along the way, these behaviors transform from helpful practices into destructive patterns that hijack your emotional state and cloud your judgment. Today, we're going to walk through 7 specific toxic habits that plague traders at every level. For each one, I'll show you exactly why your brain thinks it's helping, reveal the hidden psychological trap that's actually sabotaging you, and give you a clear, practical fix that professional traders use instead. This isn't about becoming a robot or suppressing your human nature. It's about understanding how your psychology works in the markets and aligning your habits with what actually creates consistent results, rather than what just feels productive. By the end of this video, you'll see trading differently. These toxic habits will lose their grip on you because you'll understand the illusions they create. More importantly, you'll have a roadmap for replacing them with behaviors that actually serve your long-term success. Let's dive into the first trap that catches almost everyone. Toxic habit number 1. Overanalyzing every trade setup. The habit. You sit in front of your charts for hours, adding indicator after indicator, zooming in and out of time frames, looking for that perfect confluence that will guarantee your trade works. You tell yourself you're being thorough, diligent, and professional. You're not gambling, you're analyzing. Why traders think it helps? This feels responsible, doesn't it? More analysis equals better decisions. More confirmation equals higher probability. If you just study the charts long enough, find enough supporting factors, and consider every possible angle, you'll crack the code. You'll find that magical setup where loss is impossible. The voice in your head says, professional traders do thorough analysis. I'm not rushing into trades. I'm being patient and methodical. The more I analyze, the more confident I can be. But here's what's really happening. You're feeding an illusion of control while simultaneously training yourself to be paralyzed by indecision. Overanalysis is actually analysis paralysis wearing a professional mask. Every time you add another layer of confirmation, you're unconsciously telling your brain that the trade isn't good enough yet. You're teaching yourself to doubt your initial judgment, which was probably correct more often than you think. This habit triggers what psychologists call the paradox of choice. The more options and factors you consider, the less confident you become in any decision. You end up missing trades because you're stuck in analysis mode, where you finally enter trades so late that the risk-reward ratio has completely deteriorated. Worse yet, overanalysis often becomes a way to avoid the emotional discomfort of taking risk. As long as you're analyzing, you're not risking money. As long as you're searching for more confirmation, you don't have to face the possibility of being wrong. Think about it like this. Overanalyzing a trade setup is like a chef who keeps tasting the soup and adding more ingredients because they're afraid to serve it. Eventually, they've overthought it so much that they've ruined the original recipe. The soup that would have been perfectly fine becomes an inedible mess. Professional traders understand that good enough is good enough. They develop a clear, predefined set of criteria for their setups. And when those criteria are met, they act. No additional analysis. No second-guessing. No hunting for extra confirmation. Here's your practical fix. Create a simple checklist for your trading setup. No more than 5 criteria. When all 5 boxes are checked, you enter the trade within 60 seconds. Set a timer if you have to. This forces you to trust your methodology instead of endlessly tweaking it. The psychological reframe is this. Analysis has diminishing returns. The goal isn't to be right 100% of the time. It's to be consistently profitable over a series of trades. Perfect analysis doesn't exist, but consistent execution does. Remember, professional traders are paid to make decisions under uncertainty, not to find certainty. The moment you accept that uncertainty is permanent, analysis becomes a tool rather than a crutch. Toxic habit number 2. Moving stop losses to give trades breathing room. Your trade is approaching your stop loss, and you think, this is a good trade. The market is just being choppy. I'll move my stop back a little bit to give it some breathing room. It feels rational, flexible, and patient. After all, markets are unpredictable, and sometimes good trades need space to work. Why traders think it helps? Moving your stop loss feels like you're being adaptable rather than rigid. You tell yourself you're reading the market's rhythm, being flexible with your risk management, and not letting temporary noise stop you out of a winning trade. The internal justification sounds like, I'm not being stubborn, I'm being smart. Markets breathe, and I need to account for that. This is still a valid setup. It just needs more room to work. I'm managing risk, not avoiding it. But here's the brutal truth. Moving your stop loss is almost never about giving the trade breathing room. It's about your inability to accept being wrong. Every time you move a stop loss away from the market, you're violating the most fundamental principle of risk management. You're increasing your risk after you've already determined what you're willing to lose. You planned your trade based on a specific risk amount, and now you're changing the rules mid-game because you don't like how the game is going. This behavior is rooted in loss aversion, the psychological principle that the pain of losing is roughly twice as powerful as the pleasure of winning. Your brain will perform incredible mental gymnastics to avoid realizing a loss, even when that avoidance makes the eventual loss much larger. Moving stop losses is like a gambler who keeps betting more money to win back what they've already lost. It feels like problem solving, but it's actually problem amplifying. You're teaching your brain that your original risk management decision wasn't really a decision at all. It was just a suggestion that can be changed when things get uncomfortable. Think of it this way. Moving your stop loss is like lying to yourself on a diet by redefining what counts as cheating. You're not solving the problem. You're just changing the definition of the problem so you can feel better about breaking your own rules. Professional traders treat their stop loss as sacred. It's not a suggestion. It's a contract with themselves. When price hits the stop, the trade is over, period. No exceptions, no special circumstances, no, just this once. Here's your practical fix. Before you enter any trade, write down your stop loss level and the dollar amount you're risking. Put it somewhere visible. When the trade moves against you, look at that number and remind yourself, this is what I agreed I could afford to lose. The trade is telling me I was wrong, and that's okay. The psychological reframe is powerful. A stop loss isn't a failure. It's successful risk management. Every time you honor your stop loss, you're proving to yourself that you can be trusted to follow your own rules. This builds the discipline muscle that separates professional traders from gamblers. If you absolutely must adjust to stop loss, only move it closer to your entry price to lock in profits, never further away. Better yet, set your stop loss and then close your trading platform. Go for a walk. Let the trade work or not work without your interference. Toxic habit number 3. Revenge trading disguised as persistence. The habit: you take a loss, and immediately you're scanning the charts for the next opportunity. You tell yourself you're being persistent, that successful traders don't quit after one loss, that you need to get back in the game quickly. You're not emotional, you're resilient. Why traders think it helps? This feels like the right mentality, doesn't it? Champions don't stay down. Successful traders bounce back quickly. You've read that you should treat trading like a business, and businesses don't shut down after one bad day. Your internal narrative sounds like, I'm not going to let one loss affect my confidence. I'm staying active and engaged. Persistence and resilience are professional traits. The best traders get right back in there. But what you're actually doing is revenge trading wrapped in the language of professionalism. You're not being persistent. You're being emotional. You're not bouncing back. You're avoiding the psychological discomfort of sitting with a loss. True persistence in trading looks like patience, not urgency. When you immediately start hunting for the next trade after a loss, you're operating from a state of emotional arousal, not calm analysis. Your brain is in fix this mode, which clouds judgment and leads to suboptimal decision-making. Revenge trading disguised as persistence is like a boxer who gets knocked down and immediately starts swinging wildly instead of taking a moment to clear their head. It feels aggressive and determined, but it's actually the behavior of someone who's been rattled and isn't thinking clearly. The most insidious part is that this habit trains you to associate trading with emotional urgency rather than calm patience. You start to believe that more trading equals more professionalism, when the opposite is often true. Professional traders understand that doing nothing is often the most productive action. After a loss, the first step isn't to find the next trade. It's to process what happened and return to a neutral emotional state. Here's your practical fix. After every losing trade, implement a mandatory 30-minute break. During this time, you're not allowed to look at charts or think about trading. Do something completely unrelated. Take a walk, read a book, call a friend. This break gives your emotional brain time to cool down and your rational brain time to re-engage. The psychological reframe is crucial. Persistence isn't about the frequency of your actions. It's about the consistency of your process. A persistent trader follows their plan even when it's uncomfortable, especially when it means sitting on their hands instead of forcing trades. Remember, the goal isn't to trade as much as possible. It's to trade as well as possible. Sometimes the most professional thing you can do is close your trading platform and walk away for the day. Toxic habit number 4. Overtrading for discipline building. The habit. You believe that trading more frequently will make you a better trader. You think that practice makes perfect, so you force yourself to find trades even when the setups aren't ideal. You tell yourself you're building discipline, staying sharp, and getting more experience. Why traders think it helps? This seems logical on the surface. Athletes practice every day. Musicians play scales daily. More repetition should equal better skills, right? You convince yourself that each trade is a learning opportunity, that staying active keeps you engaged with the market, and that discipline means trading consistently, not sporadically. The voice in your head says, I need to stay in practice. Discipline means showing up every day and putting in the work. The more trades I take, the more experience I gain. Sitting on the sidelines doesn't make me better. But here's the problem. Overtrading is the enemy of discipline, not the manifestation of it. When you force trades that don't meet your criteria, you're actually training yourself to ignore your own rules. You're teaching your brain that your standards are flexible and that action is more important than patience. This habit is rooted in what psychologists call action bias, the tendency to believe that doing something is always better than doing nothing, even when doing nothing is the optimal choice. In trading, this bias is deadly because it leads you to mistake activity for productivity. Overtrading also creates a vicious cycle. The more marginal trades you take, the more losses you're likely to experience. These losses create emotional stress, which makes you want to trade more to fix the problem. You end up in a hamster wheel of activity that feels productive but actually degrades your performance. Think about it like this. Overtrading for discipline is like a sniper who fires constantly to stay sharp. The sniper's job isn't to fire as many bullets as possible. It's to wait for the perfect shot and then execute it flawlessly. The discipline is in the waiting, not the shooting. Professional traders understand that discipline in trading looks like patience, not activity. The best traders often trade very infrequently, sometimes going days or weeks without taking a position because they're waiting for their optimal setups. Here's your practical fix. Set a maximum number of trades you're allowed to take per week. Start with 5. Once you've hit that limit, you're done trading for the week, regardless of what opportunities appear. This forces you to be selective about which setups truly meet your criteria. The psychological reframe is important. Discipline isn't about consistency of action. It's about consistency of standards. A disciplined trader says no to more trades than they say yes to. The goal is quality over quantity, precision over activity. Start thinking of yourself as a sniper, not a machine gunner. Your job is to wait patiently for the perfect shot, then execute it with precision. The discipline is in the waiting, the patience, and the selectivity, not in the frequency of your actions. Toxic habit number 5. Chasing confirmation bias for confidence. The habit. After you enter a trade, you spend time looking for additional analysis that supports your position. You seek out other traders who agree with your view, find news articles that confirm your thesis, or hunt for technical indicators that validate your decision. It feels like you're building confidence and staying informed. Why traders think it helps? This feels responsible and thorough. You tell yourself you're staying informed about your positions, building confidence in your trades, and making sure you haven't missed any important information. It seems professional to continuously monitor and validate your decisions. Your internal justification sounds like, I want to stay on top of my trades. Good traders know why they're in positions and keep track of relevant information. Building confidence in my analysis helps me hold winners longer. But what you're actually doing is feeding confirmation bias, the tendency to search for, interpret, and recall information in a way that confirms your pre-existing beliefs. Instead of building genuine confidence, you're creating false confidence based on cherry-picked information. This behavior is psychologically dangerous because it trains your brain to ignore contradictory evidence. When you actively seek confirmation for your trades, you unconsciously filter out information that might suggest you're wrong. You start living in an echo chamber that reinforces your biases rather than challenging them. Confirmation bias in trading is like a doctor who only looks for symptoms that support their initial diagnosis, while ignoring symptoms that might suggest a different condition. It feels thorough, but it's actually dangerously narrow thinking that can lead to catastrophic misdiagnosis. The worst part is that this habit makes you emotionally attached to your trades. Instead of holding positions based on objective criteria, you start holding them based on the emotional investment you've made in being right. Your ego becomes tied to the outcome, which clouds your judgment about when to exit. Professional traders practice what's called steel manning, the opposite of confirmation bias. Instead of looking for information that supports their position, they actively seek out the strongest possible arguments against it. Here's your practical fix. After entering any trade, spend 10 minutes writing down 3 reasons why the trade might fail. Look for evidence that contradicts your thesis. Seek out opposing viewpoints. This practice keeps you intellectually honest and emotionally detached from the outcome. The psychological reframe is crucial. Confidence in trading shouldn't come from reinforcing your existing beliefs. It should come from having thoroughly tested those beliefs against opposing evidence and having clear criteria for when you'll change your mind. Remember, the goal isn't to be right about every trade. It's to be objective about every trade. The moment you start rooting for your positions instead of managing them, you've stopped being a trader and become a fan. Fans are emotionally invested in outcomes. Traders are emotionally detached from them. Toxic habit number 6. Comparing performance to others for motivation. You follow other traders on social media, check their results, compare your performance to theirs, and use it as motivation to improve. You look at their winning streaks and think, I need to trade like that. You believe that competition and comparison drive excellence. Why traders think it helps? This feels motivating and educational. You tell yourself you're learning from successful traders, staying competitive, and pushing yourself to improve. Comparison seems like a natural way to gauge progress and identify areas for growth. Your internal narrative sounds like, I can learn from other successful traders. Healthy competition makes me better. I need to know where I stand relative to others. This motivates me to work harder and improve my performance. But comparison in trading is a psychological quicksand that destroys your emotional equilibrium and distorts your decision-making. Every time you compare your results to someone else's, you're comparing your behind-the-scenes struggles to their highlight reel. This habit triggers what psychologists call social comparison theory, the tendency to evaluate yourself relative to others rather than against objective standards. In trading, this leads to several destructive behaviors. You start chasing other people's strategies instead of developing your own. You begin taking unnecessary risks to match other people's returns, and you develop feelings of inadequacy that can lead to revenge trading. Comparison also creates a false sense of urgency. When you see someone else making money quickly, your brain starts believing you're falling behind and need to catch up. This urgency corrupts your patience and leads to forced trades and increased risk-taking. Think about it like this. Comparing your trading performance to others is like comparing your marriage to what you see on social media. You're comparing your complete reality to someone else's curated highlights, and it's a recipe for dissatisfaction and poor decisions. Professional traders understand that trading is not a competition. It's a personal journey of skill development and psychological mastery. Your only meaningful comparison is to your own past performance and your own defined goals. Here's your practical fix. Stop following other traders' daily results. Unfollow the social media accounts that post screenshots of winning trades. Instead, focus on your own trading journal and track your own progress over time. Compare this month's performance to last month's, not to someone else's. The psychological reframe is liberating. Your trading success is not relative to anyone else's success. The market is big enough for everyone to win in their own way, on their own timeline, with their own strategy. Success in trading is measured by consistency and sustainability, not by who can make the most money the fastest. Remember, every trader has a different account size, risk tolerance, strategy, and set of life circumstances. Comparing your results to theirs is like comparing your marathon time to someone who ran a different race on a different course in different weather conditions. It's not just meaningless, it's counterproductive. Toxic habit number 7, incorrect journaling, focusing on outcomes instead of process. You keep a trading journal, but you focus primarily on whether trades were winners or losers. You feel good when you write down wins and bad when you record losses. You judge the quality of your trading decisions based on their outcomes rather than the process that led to them. Why traders think it helps? Keeping track of wins and losses seems like the obvious way to measure progress. You tell yourself you're being accountable, learning from your mistakes, and tracking your improvement. It feels professional and organized. Your thinking goes, I need to track my results to know if I'm improving. Winning trades are good decisions. Losing trades are bad decisions. By recording everything, I can see patterns in what works and what doesn't. But outcome-focused journaling is one of the most psychologically destructive habits a trader can develop. When you judge the quality of your decisions based solely on their results, you're training your brain to associate good process with good outcomes and bad process with bad outcomes, which is not how markets work. In reality, you can make a perfect trading decision and lose money, or make a terrible trading decision and make money. Markets are probabilistic, not deterministic. When you journal based on outcomes, you're reinforcing superstitious thinking rather than analytical thinking. This type of journaling creates what psychologists call outcome bias, the tendency to judge the quality of a decision by its outcome rather than by the quality of the decision-making process. This bias leads to several problems. You start avoiding good setups because they recently produced losses. You repeat bad decisions because they recently produced wins. And you develop emotional attachments to specific strategies based on recent results rather than long-term statistical validity. Outcome-focused journaling is like a pilot who judges the quality of their flying by whether they encounter turbulence. Turbulence has nothing to do with flying skill. It's a random environmental factor. Similarly, individual trade outcomes often have nothing to do with trading skill. They're random market fluctuations. Professional traders journal their process, not their outcomes. They evaluate the quality of their decisions independent of the results those decisions produced. Here's your practical fix. For every trade, write down answers to these process-focused questions. Did I follow my entry criteria? Did I manage risk according to my plan? Did I exit based on my predetermined rules? Was I in the right emotional state when I made decisions? Grade yourself on these process metrics, not on whether you made or lost money. The psychological reframe is crucial. A good trade is one where you followed your process perfectly, regardless of the outcome. A bad trade is one where you violated your rules, regardless of whether you made money. This reframe helps you learn from the things you can control, your process, rather than obsessing over things you can't control, random market movements. Start thinking of yourself as a process engineer, not an outcome collector. Your job is to design and refine a process that produces consistent results over time, not to predict the outcome of any individual trade. Now that we've walked through these 7 toxic habits, I want you to take a moment and notice something important. How do you feel right now? If you're like most traders, you're probably experiencing a mix of recognition and relief. Recognition because you've seen yourself in several of these habits. Relief because you finally understand why certain behaviors that felt professional were actually working against you. This recognition is incredibly liberating. It means you're no longer unconsciously sabotaging yourself. You can't unsee these psychological traps now that you understand them. Every time you catch yourself starting to overanalyze a trade, or feeling the urge to move a stop loss, or hunting for confirmation bias, you'll remember this video and make a different choice. The beautiful thing about understanding your own psychology is that awareness itself is half the cure. When you recognize a toxic habit in real time, you have the power to interrupt it. You can pause, take a breath, and choose a different response, one that serves your long-term success rather than your short-term emotional comfort. Trading doesn't have to be an emotional roller coaster. It doesn't have to be stressful, overwhelming, or psychologically exhausting. When you replace these toxic habits with professional behaviors, something magical happens. Trading becomes simpler, calmer, and more consistent. You stop fighting the market and start working with it. You stop trying to control outcomes and start controlling your process. You stop measuring yourself by daily results and start measuring yourself by daily consistency. This shift in focus transforms not just your trading results, but your entire relationship with trading. Let's step back and see the bigger picture here. These toxic habits all share a common thread. They come from trying too hard to control things you can't control or seeking short-term emotional comfort at the expense of long-term success. Overanalyzing comes from trying to eliminate uncertainty. Moving stop losses comes from trying to control outcomes. Revenge trading comes from trying to fix emotional discomfort quickly. Overtrading comes from confusing activity with productivity. Confirmation bias comes from trying to eliminate doubt. Comparison comes from seeking external validation. Outcome-focused journaling comes from trying to find simple cause and effect relationships in a complex system. But professional traders operate differently. They accept uncertainty as a permanent feature of markets. They control what they can control, their process, their risk management, their emotional state, and they let go of what they can't control, whether any individual trade wins or loses. This is more than just a change in behavior. It's an identity upgrade. You're moving from the identity of someone who trades emotionally to someone who trades professionally. From someone who seeks certainty to someone who manages uncertainty. From someone who reacts to someone who responds. Professional traders trade less, not more. They think more clearly under pressure. They measure themselves by process metrics rather than daily P&L. They treat trading as a skill to be developed over years, not a game to be won daily. The habits we've discussed today are the bridge between amateur and professional thinking. Every time you choose the professional response over the amateur reaction, you're literally rewiring your brain for success. You're building new neural pathways that support calm, consistent decision-making under uncertainty. This journey isn't always comfortable. Professional habits often feel less satisfying in the short term than emotional reactions. It's more fun to overanalyze than to trust your process. It's more satisfying to seek confirmation than to challenge your biases. It's more exciting to trade frequently than to wait patiently for perfect setups. But this is exactly what separates professionals from amateurs. Professionals do what works over what feels good. They prioritize long-term success over short-term emotional satisfaction. They understand that comfort is often the enemy of growth. Remember, you're not trying to become a robot. You're trying to become a professional who understands their own psychology and has developed habits that work with human nature rather than against it. Professional traders aren't emotionless. They're emotionally intelligent. They feel the same impulses you do. They just train themselves to respond differently. Here's what I want you to do right now. Think back through these 7 toxic habits and identify the one that hit you the hardest. Which one made you think, "Oh no, that's exactly what I do"? That's your starting point. Don't try to fix all 7 habits at once. That's just another form of overanalyzing. Pick the one that resonated most strongly and commit to replacing it with a professional alternative for the next 30 days. If it was overanalyzing, commit to your 5 criteria checklist and 60-second entry rule. If it was moving stop losses, write down your stop and dollar risk before every trade and treat them as sacred. If it was revenge trading, implement the mandatory 30-minute break after every loss. Focus on one habit, master it, then move to the next. This is how you build sustainable change, one professional behavior at a time. I'd love to hear from you in the comments. Which toxic habit hit you the hardest? Which one are you going to work on first? Your honesty might help another trader realize they're not alone in these struggles. If this video helped you see your trading psychology more clearly, consider subscribing to this channel. We dive deep into the mental game of trading because that's where the real edge lies. Not in finding the perfect indicator or strategy, but in mastering the psychology that drives consistent execution. Remember, the market hasn't changed much in the past 100 years, but understanding of human psychology has advanced dramatically. Use that to your advantage. The traders who succeed in the long run aren't necessarily the ones with the best analytical skills. They're the ones with the best psychological skills. Your journey from amateur to professional isn't just about changing what you do. It's about changing who you are. Every professional behavior you choose over an emotional reaction is a vote for the trader you're becoming. Make sure you're voting for someone you'd want to trust with your financial future. The markets will be here tomorrow, next week, and next year. But the habits you build today will determine whether you're still trading profitably when those future opportunities arise. Choose wisely, trade professionally, and remember that the best traders aren't the ones who never make mistakes. They're the ones who learn from them the fastest. Thanks for watching, and I'll see you in the next video where we'll continue exploring the psychology of successful trading.